Good morning, students. We will be discussing July 2021 your paper SL2 Corporate Finance and Risk Management. I will be taking through the paper one by one. Actually, there are three questions, as you all know. 1 and 2 are 25 marks questions, and 50 marks question is the third one, which is a case study. So we will take step by step. Let's look at the question number 1. So you could see it's about a company called Cold Ice PLC, manufactures cold beverages and frozen products, and they have given you the financial statements. Actually, not the financial statement, the ratios on the financial statements as of 31st March 2021. So you can see there are ratios, few ratios have been given. Then going down, the market price per share is given, dividend per share given, number of shares, and there are few financial information they have extracted: finance costs, current liabilities, total assets, and the effective tax rate. And then they have given you the industry, comparative industry ratios, few ratios from the same industry: return on equity, operating profit margin, debt to equity ratio, current ratio, P ratio. Now, first of all, you need to understand that the financial analysis area, or the concepts, or maybe the syllabus area, financial analysis, what is expected is you should be able to calculate the ratios, and you compare with either with the your past information, or with the budgeted information, or the industry information. So the comparison could be with one of these, and generally the industry information, if it is properly available, you could compare and see whether your company is in the same level, or it has performed better than the industry, or it has to improve. So this is basically the financial analysis area what you have to know or learn. So the question here, 15 marks question, it's the first question, 15 marks. Evaluate the performance of CIP during the year ended 31st March 2021. So what they are asking is you to performance evaluation of the company for the period 31st March 2021. Only they say that. So it's a 15 marks question. The question is only evaluate the performance. Now we all have to understand they have already got some ratio calculator, some ratios, and then they have given you the further information on the financial, and they have given you the industry information. So what we have to do, we have to understand that for us to say whether the company has performed well or not, sometimes you can look at the company ratios and get some idea, but sometimes that ratios alone will not answer or solve your question. It has to compare with somebody. So the somebody's information is also given. So what I would like to say, you have return on equity and operating profit margin, then debt to equity ratio, and the current ratio, and the P ratio. This is given for the industry. So we need to firstly know, for us to compare the company performance with the industry, we need to know the same 5 ratios of the company. So if I want to say, I need to know the company same ratio. So they are given for the industry return on equity 10%, and operating profit margin 20%, debt equity ratio 0.10, and current ratio 2 times or 2, and the P ratio 18 times. This is 18 times. So you need to know this is the industry information. We need to calculate the company specific, that is called Ice PLC companies ratios, and compare with this industry. That would be the kind of expectation, because otherwise you can't just look at the company ratios and say, okay, if I just say GP margin 36%, what do I say about GP margin? Whether the GP margin 36% is generally a good ratio, good GP margin for the company, or the industry, I don't know. So I need to know some benchmark to compare with. Either you should be given the previous year. Then the previous year information I can say GP margin last year 30%, this time 36%. I can say the company has performed better than last year. That's all I can tell. But if you are saying the GP margin of the industry is 40% and this company 36%, then I can say the company has not performed up to the industry level. So this is basically the ratio analysis or the financial analysis area where the knowledge needs to be developed so that you can compare and see whether the company perform or not. So coming back, industry, these ratios are given. So we need to look at the company same ratios. Only thing, here we are not given the P&L balance sheet. If you are given a P&L balance sheet, straight away you calculate all these ratios and compare, and once and for all you can finish it. But purposely the examiner has given in different manner where he has given few ratios of the company and certain financial information, extracted information from the P&L balance sheet. So what we have to know, in order to calculate each of these ratios, you need to know the ratio properly. You need to know the ratio properly in the numerator and denominator, what it consists of, you should be very clear. So if you take return on equity, all of us know return on equity is calculated profit after tax divided by equity. Profit after tax divided by equity. And operating profit margin, you should know that your EBIT or the operating profit divided by sales. The margin, wherever the word comes with the margin, always remember you are talking about the comparison with the sales. It can be GP margin, it can be operating profit margin, it can be net profit margin. All the margin relates to sales. So the sales and EBIT you compare and get the operating profit margin. Debt to equity, that is actually your debt divided by equity, the ratio. Current ratio, as we all know, current asset is to current liability. P ratio is market price divided by earning per share. P ratio is market price divided by earning per share. So these are the descriptive formulas for the ratios what has been given. So we need to be very clear. So that is actually examiner, this is actually a very easy question. But if the students were not able to understand each and every ratio variable correctly, and you have to have a good knowledge about relationship with the other variables in the other ratios, so that you can think within the time frame and quickly calculate all these ratios. Otherwise it will be a very difficult task for you, because you need to know where to start. The question is about comparison, just a comparison, or they are asking for performance of this company. So in order to calculate the performance of this company, we can look at the, like say, dividend cover 1.14. So what? Dividend cover 1.14. Whether that dividend cover is showing the company has done really well or it is sufficient, we don't know. So that's what they are given the industry information, so that you can be able to compare. So we have this industry information or ratios, and these are the ways you calculate. Now you have to find out, in order to calculate each of these ratios, what information available in the question. So return on equity needs profit after tax and equity. So just go through the information available, profit after tax and the equity. Do we have information about profit after tax? I don't think anywhere they have given the profit after tax. But they have given certain ratios. Now you can look at the information available. Dividend cover is given. Dividend cover mean what? You need to understand dividend cover is calculated by comparing the dividend and the profit after tax. So how much profits you have to pay dividend, that basically shows the dividend cover. So dividend cover you have been given 1.14. Based on that we can now think, okay, I can calculate I know the dividend cover, right? So I need to find out how much of profits I am going to have. So if you really look at, they have given you I am just taking the suggested answer so that you can look at it. So dividend per share is given 19.25, and the dividend cover is given 1.14. So when I multiply dividend per share by the dividend cover, I will get the earning per share. So that's basically the first part of the answer. You can see the table, right? I'm not writing down, it's in the suggested answer. You can go through. So 21.95 is the earning per share. So that is per share how much the profit after tax the company has. If you want to know the total profit after tax, you multiply the earning per share by the 98 million shares. 98 million company has shares. One share, the earning per share is 21.95. So 2,151,100 is the net profit. So that is actually the profit after tax we need for return on equity calculation. So we have got the profit after tax. So you know that one portion of the information we have calculated, profit after tax. Then we need the equity. So in order to calculate equity, what information they have given? They have given you the debt ratio. Actually debt ratio, it's not very, if you take the past papers, I don't think the debt ratio was ever tested or ever given, right, debt ratio. So but the debt ratio represent out of your total assets, what is your debt component? Or in other words, how much debt had been used to fund your total assets. If you say equity ratio, out of your total assets, how much had been funded by equity money or shareholders money. So debt ratio means the out of total assets of the company, how much debt money had been used or how much debt had been used to fund the assets. On that way, they are given debt ratio as 21%. So we should know that debt ratio is 21 mean equity ratio is 79%. So equity ratio, we know that equity ratio is 79 and we know the total assets. They are given in the question the total assets amount. So you can go down, just look at the answer here. Total assets is given as 17.5, that is given in the question, 17.5 million, and the equity ratio is, as I mentioned, debt ratio if it is 21%, equity ratio, the shareholders money to use for the investment in assets, 79%. So 79% into 17.5 million assets is given as 13.8 billion. It's all billion, 13.8 billion. 13.8 billion is the equity money. So we now know profit after tax we know and the equity we know. So you can now look at your return on equity, 2.1 million divided by 13.8 billion. That gives you return on equity of 15.48%. 15.48%. So please note that we have got the profit after tax from one relationship and we have got the equity amount from another relationship. So basically we comparing the variables, we have got profit after tax and the equity and got the return on equity for the company. So this is how each and every ratio you need to get it by taking the variables from other ratios what is given in the question. Then operating profit margin. As I mentioned, operating profit margin is about comparing the EBIT or the operating profit to the sales. So we need to find out, as the examiner given the information about sales and the operating profit margin. So look at, they have given you gross profit margin and net profit margin they have given. So you need to find out, do we have the operating profit margin information, that is your sales. Yeah, they have given you net profit margin. So if you go to your calculation, you can calculate your sales from the net profit margin. So they have given you net profit margin as 17%. So we know the profit, net profit we know, that is 2.1 billion, that we got it for the return on equity calculation. So you can see in the answer, net profit 2.1 billion, which is 17%, that is the margin. So if the net profit is 17% and total sales will be 12.6 billion. So that we have calculated 12.6 billion as the sales of the company. Based on the margin, net profit represents 17% of margin, so the sales value is 12.6 billion. So that we have got. Then the operating profit we have to find out. So if you go down, operating profit for you to calculate, you know the profit after tax. You know the profit after tax, that is what we calculated for return on equity. So if you know the profit after tax, they are given in the question, effective tax rate of the profit before tax was 19.75. So profit before tax and the effective tax rate. So it's 19.75. So if you know the profit before tax is 100, your tax is 19.75 in the P&L. And your profit after tax will be how much? Balance 80.25. So your profit before tax, on that you calculate 19.75 taxation, and profit after tax will be 80.25. So we know the profit after tax. So what we can do, we can calculate the profit before tax. So you can see that on the income tax calculation, they have calculated 2.1 billion is your profit after tax, which is 80.25. Then you multiply by 19.75, which gives you the tax amount of 529 million. So that's your tax amount. You can, it's basically a relationship based question, all the variables. If you know the ratio, it's a matter of you dividing and multiplying the relevant variable. So income tax is 529, and we already got the net profit 2.1 billion. Then we have to calculate the finance cost. I think they are given finance cost in the P&L 305 million. 305 million in the finance cost in the P&L. Not P&L, the information given 305 million. But they have given further information. Average finance cost on the closing total interest bearing debt. Average finance cost on the total interest bearing debt is 13.75. That means they are relating the finance cost in the P&L with your balance sheet closing balance of interest bearing loans. Because we all know that finance cost is calculated based on a loan outstanding. Loan outstanding can vary from January to December or April to March. That entire year, the loan outstanding can change because the customer or the company will repay the loans. But in order to simplify the calculation, they can say that your finance cost is a percentage of your total outstanding in the balance sheet. That's what they are given here. 13.75% of the total outstanding loan, interest bearing loan outstanding as of 31st March. On that 13.75 represent finance cost. So finance cost is given as how much? 305 million. Yeah, you can see the total debts or total interest bearing liabilities. 305 million is your finance cost. Finance cost percentage is 13.75. So when you divide the 305 million with 13.75, you get 2.2 billion is your debt capital in the balance sheet. So interest bearing loans is in the balance sheet is 2.2 billion. So keep that in mind. Now we come back to the EBIT. EBIT is net profit we calculated earlier 2.1 billion, and finance cost is given 305 million, and income tax we calculated 529 million. So when you add all these three, you are backward going. You are starting from your profit after tax, then you have to add the tax, then you got your profit before tax, then you have interest, then you get your EBIT. So actually we are going backward. We get profit after tax. So from EBIT you minus I, then you get profit before tax, then you minus tax, then you get profit after tax. So we got the profit after tax at 2.1 billion and tax is 529 million, right, 0.4529. Then you get your finance cost 305 million, 005. So when you go backward, your EBIT is coming to 2.9 billion. Right, we all know how to calculate from EBIT, I minus, then you get the tax and then you get profit after tax. This is how we the P&L represent. But from this question point of view, they don't want to come from top to bottom. Going from bottom to top, we are finding out the profit after tax, and we are calculating tax separately, and we are getting the finance cost and going backward and say what is the EBIT. So we have got now EBIT and the sales we got earlier from the net profit margin. We can now calculate the operating profit margin of the company. So you can look at operating profit margin of this company 2.9 billion divided by 12.6 billion. So that is sales and the operating profit. If operating profit EBIT. So 23.6% is the operating profit margin of this company. 23.6%. So we have got the second ratio, operating profit margin 23.6. Then we have the debt equity ratio. Debt equity ratio, we already got the debt amounts in the balance sheet, 2.2 billion. Equity we have already got for the return on equity calculation, 13.8 billion. So you can see the suggested answer, debt divided by equity 0.16. So that's your debt equity ratio. Then the current ratio, as you know, the current ratio is between current assets and current liability. How much of current assets you have to meet your current liability. So current assets and current liability for us to compare. We need to know that they have given you inventory days. So from the inventory days, you can calculate the cost of sales first, because they have given you GP margin. From the GP margin, we can calculate the cost of sales, that is sales from 12 billion, which we already calculated. On that, you compare with your GP margin and got cost of sales of 8 billion. 8 billion cost of sales. Using the cost of sales 8 billion and the inventory holding days is given as 63.85. From the inventory holding days 63.85, we can calculate how much of inventory in the balance sheet. How much is the inventory in the balance sheet? So cost of sales had been used to calculate the inventory holding period. You know that inventory holding period is equals to average inventory into 365 divided by cost of sales. Average inventory into 365 divided by cost of sales. So here the inventory holding days is given as 63.85. Average inventory we don't know, assume X. Cost of sales we got earlier, I said 8 billion, 8098, whatever, 258. So we can calculate the average inventory. So please understand, inventory holding period is given 63.85. Average inventory we don't know. We don't know the inventory. 365 multiplied and divided by cost of sales. Cost of sales we got it from the sales. We deduct the GP margin or GP amount, then you get a cost of sales. So that is 8 billion. So when you use this, you get average inventory. So the average inventory, the suggested solution, you can see 1.4 billion. So we have got the average inventory 1.4 billion. So how do you take it forward? You are given current liability 2.1 billion. So they are given a current liability of 2.1 billion and the quick ratio. As you know, the quick ratio is calculated between current assets minus inventory to the current liability. So you are looking at the liquid assets. So current assets minus liability, current assets minus inventory compared to your current liability, how much you have liquid assets. So we have known the current liability which is given in the accounts, and we know the inventory, and we know the quick ratio. So what you can calculate, current assets. So you can look at here, current asset less inventory is current liability into quick ratio, which is 1.9 billion. Current asset going to be 1.9 billion plus inventory 1.4 billion, 3.3 billion. I am sure all of you all can understand that. These are just understanding your variables of the relationships of the formulas. So as far as you understand each and every ratio, what it represents, current ratio represents current assets and current liability. Quick ratio represents current assets minus inventory, that means you exclude the inventory compared to current liability. So those relationships, if you are very clear, it's nothing in this exam question. Right? So you got this current asset 3.3, then we go into current ratio 3.3 billion versus 2.1 billion current liability which is given in the accounts, 1.54. Then the PE ratio. P ratio, where you need the market price and earning per share. Earning per share already we got, right? Earning per share we calculated earlier at the beginning, I think the first one. Earning per share 21.95, and the market price is 660. So you know the 21.95 is your earning per share, 660 is your market price. So your P ratio 30.07, P ratio 30.07. So these are the ratios of the company against the industry ratio. So this is basically the examiner's requirement. 15 marks question. I am sure like this very what you call the bonus marks. If you are very much clear about each and every ratio variable, what variable represented in the ratio. Operating profit margin mean what? It's about EBIT and sales. Debt equity ratio mean what? Right? Only one ratio if at all which was not used in the past papers is the debt ratio. That's why I said debt ratio is total assets, what percentage of debt money had been used to fund the total assets. That is debt ratio. Equity ratio is out of total assets, how much of equity money had been used. So that is the only thing which is a kind of a new thing comparatively. But all other ratios are well known and it has been used in many past paper questions. So nobody can have difficulty in calculating these numbers. Right? Only thing you might have few minutes time to understand, to relate variables, because it's not straight away you are given a P&L and balance sheet and asking you to calculate ratio. If that is the case, there is no question about it. But they have given you different variables, so you need to figure out how do I get this information. If I have been given quick ratio, I need to know quick ratio represent current assets minus inventory to the current liability. They have given the current liability, but they have not given the current assets, they have not given the inventory. So I need to find out current assets minus inventory separately, then inventory separately, then get the current assets. So I believe that you are clear on that. Now coming to the performance comparison. This is your company, this is the industry. ROE, return on equity, that is the shareholder return. End of the day, the entire world corporates are working to achieve the primary objective, that is the maximizing shareholder wealth. So we all work for, as organization, work for maximizing shareholder wealth. So shareholder wealth will be maximized based on the shareholder returns. So return on equity is one of the key return requirement, or return basically company generate to give it to shareholders. So here the industry is earning 10% return, whereas this company is earning 15%. So really good performance. If you really look at it this way, performance is very good, very good. Because you have got 15%, which is 50% more than your return on equity of the industry. That means your company is really good performing compared to industry, right? Maybe if you really look at it, there can be some more companies in the market where the performance could be very low. That's why your average industry ratio is lower than, very lower than your company. Your company may be very well performed in terms of your returns for the shareholder. Operating profit margin 20%, 23, again it's also good performance, right? Good performance. Why? You have earned more than the industry operating profit margin. That is your operational profit or EBIT. Debt to equity, if you take here 10%, here 16%. So you are actually speaking, even though you have a little higher gearing compared to industry, but your gearing is very low, right? Generally if you say this is 1, debt equity is 1, then you can say that you have 50-50. If your debt equity is 1, then you can say 50-50. That means debt amount and equity amount is both are equal, that means company is funded equally. But here your industry is like that, 10%, here 16%, that means very low. Even though you are more than the industry, you are anyway what you call lower geared. So I would say like this company can go for further funding, further debt funding is preferred. Debt funding is preferred. Because you are a profitable company, you are making money, So you can make more money if you fund from your debt capital. If you can fund from your debt capital, you can earn more. One of the important ratio is operating profit margin. Operating profit margin. That gives you 23.6%. Right? So you are earning a good return. Good return. So you can now consider still the company is profitable. Company is profitable. You can borrow money. You can borrow money and benefit the shareholders. That's a gearing. That's gearing. So you can gear further and benefit the shareholder. And this company, if you really look at, the gearing is very low gearing. So you have enough chance to borrow money to expand your business and make more return for shareholder. So that way the shareholder return can further increase because you can still go for gearing because you are a low geared company. If you are not a profit making company or if you are a high geared company, we can't comment on that. We should not recommend the further gearing. But here you have enough profits or you are making enough profits and you are low geared, very low geared. Even though it looks like industry when you compare you are a little higher, but it doesn't matter. You are still a very low geared company. You have enough potential to borrow money and expand your company so that your business will give you more return to the shareholder. That's the primary objective. Okay, so keep that in mind. It may be important to tell the examiner that you are aware of this gearing principle because at the end of the day, corporates play with the gearing. Right? You can play with the gearing to make more return for shareholder. Current ratio 2 and 1.54. Even though the general guideline we think 2 current ratio 2 is good. 2 is good. So 1.5 means you are not having enough liquidity. Don't think like that because even with 1.5, that means to pay 1 rupee liability you have 1.5 rupees. To pay 1 rupee liability you have 1.5 rupees. So it's a good thing. To pay 1 rupee you have 1.5, more than 1 rupee. So you are not in a trouble, you are not in difficulties. But when you take this company quick ratio it's 0.89. So to pay 1 rupee of liability, current liability, you have 0.89. That is 89 cents only you have in terms of liquid assets. When you take out the inventory, you have only 89 cents to pay the liability. So when you consider quick ratio, you have a slighter concern because you are not having enough money to pay your liability. But current ratio per se, 1.5 is not a bad thing. So you might say that it's good, but only thing you need to understand, quick ratio indicates concern. Right? So better that we concentrate and improve the liquidity position, even though current ratio doesn't reflect that properly. Quick ratio shows that you have 0.89. That means you need to be very much careful because to pay 1 rupee current liability, you have only 0.89 or 89 cents. Liquid assets. So if you are going to pay day-to-day payments, if you don't have liquid assets, you are in trouble. So better we try to sort out that. That's only concern area you may have to mention here. Gearing is a good suggestion. That is for the betterment of the company, further betterment, you can do that. Even if you don't do it, it's not a problem for the company. But a current ratio aspect or a quick ratio aspect, I think that better we communicate to the management to improve on it because otherwise you will get into problem. Actually the industry, they have not given a quick ratio, but we are aware of the information, so better we comment about it. P ratio 18 times and 30 times. 18 times and 30 times. P ratio 18 times and 30 times means 18 times of P represent your company's market price represent 18 times of earnings. 18 times of earning. But industry has 18 times, your company has 30 times. So you are priced at 30 times of your earning per share. So we may not have enough information about the company, but still compared to industry, your company is valued in the marketplace, valued very high. So it could be due to your company, the strategies your company had been allowing, or your company management style and your risk management and your branding. All that could be considered by the marketplace, and they know that your company has a very good potential of growing faster than the industry. If that investor's perception is that, then your market value will be very high compared to the industry companies. So in a way, it looks very good perception of the investor. Very good perception of investor. So the P ratio indicates that the management characteristic or good management, risk management is good or bad, and your growth potential, all that is considered in your PE ratio reflection. So if you say that compared to industry your PE is good, that means your company has a very good name or very good acceptance in the market about your future and your management styles. So therefore please note, it's a good thing, it's a good thing. So your market price is very high compared to the other company. But when you take the overall picture, other than the liquidity in terms of quick ratio, I have to mention that other than the aspect of the quick ratio, all other ratios reflect that your company is really performing well, So that's basically this question number A part, It's mainly the ratio relationships. As far as you are very thorough with your formulas, I don't think anyone will have any problem in getting the marks here. You can get the 100% marks because there is nothing that seriously you have to worry about, other than maybe a couple of comments that I mentioned at the late. Maybe the suggested answer doesn't talk about those comments on the liquidity concern and the gearing. Gearing you can improve to make more return for shareholder. So therefore I believe that those are additional comments I have made compared to the suggested answer. So moving to B part. B part of the question 1. It's about Synergy PLC, a diversified conglomerate. They are told they are planning to increase the production capacity and a new machine is required to carry out the increased production, and it costs 50 million. So immediately you have to pay 50 million for the plant, and the new machine has a 5-year useful life and a 0 scrap value, and they are given you selling price 160, and that price will go up in the second year by 5% onwards. That means second year onwards means second year that price will be 5% more, third year further 5% more, fourth year 5% more, like that it goes. So we need to get that understanding clear. Now we are talking about today, that is year 0, but first year your selling price will be 160. Why? They are saying the only price increase is happening on the second year, so not in the first year. Otherwise they should have told you the present prices will go up every year by 5%, but it's given in second year. So first year no increase of your selling price 160, but second year onwards every year the 5% increase is there. Variable cost 125 rupees, which will go up by 3% from 2 onwards, again the year 2 onwards, every year it will go up. Incremental fixed overheads, it's only relevant for investment appraisal, would be 6 million, and this will increase by 2%. So you need to understand that your fixed cost, incremental fixed cost, which will be a relevant cash flow, 6 million will go up by 2% from every year. So that means your figure, what you call the fixed overhead incremental will be increasing 2% every year. Then the volume they are given, year 1 to 5, the numbers are given there, and the cost of capital for discounting the investment appraisal 12.5 is given. So it's a very easiest question you could ever expect in a paper like this in chartered final level, because it's a simple NPV analysis where they are talking about, question is assess the sensitivity. So you need to know the sensitivity about the product selling price and variable cost. There are 2 variables they are given, so it's basic foundation level question, right? Sensitivity of your selling price and variable cost to the project, and the comment on the sensitivity to the variable 10 marks. So going to the suggested answer, I don't take much time on that. I think the suggested answer has always the relevant learning outcomes and the study pack reference, because those are the important thing when you are looking at it. Maybe I am not taking page by page to the study pack or reference. You have to go through the study pack and see the relevant pages or relevant concepts they are discussion, and the learning outcome, what is expected from this paper, what is expected. So you need to know that learning outcome, so that you will address that each and every time you attempt the question. Okay. So going to the question 1b, you can see that they have given you year 1 to 5, the selling price as I mentioned 160 is the selling price year 1, that goes up by 5% every year till 5 years. Variable cost 125 in year 1, again goes by 3% every year, that's given there. Volume of course it's given in the table, straight away you take it. Then what you have to do, you have to calculate your basic NPV calculation. You can see that the years are given year 0 to 5 and your discounting factor at the 12.5, the cost of capital given, they don't confuse you, simply they are given you cost of capital as 12.5. So you have to calculate discounting factor for year 1 to 5. The initial investment 50 million and the sales, you need to multiply your volume by the quantity. As I mentioned, the table is given on the top. So you multiply your selling price 160 with volume 500,000, that gives you 80 million sales. So year by year you have to multiply your selling price in the volume. That table you can use it to multiply, so that's given in the sales column. Then a variable cost, they have given you the variable cost per unit and the volume. So you have to multiply those two variables and get the variable cost year 1 to 5. Then a fixed cost, as I mentioned, it is starting from year 1, 6 million, but the increase is happening, 2% increase is happening, not from the second year it's increasing. So they have given you 6 million for the year 1, 6.120 second year, like that it goes up. So you can see that simple initial investment, investment appraisal, your NPV is 10 million 629, that is 10.6 million, your NPV, it's a positive NPV. So we know that the company's investment is feasible because it has a positive NPV. So whenever we say a positive NPV, that we know that value is going to be created for shareholders, so it's accepted, project is accepted. So it's not about whether accept or not, the question is about sensitivity. So for us to calculate the sensitivity, right, so you need to find out, here we are talking about two variable, selling price. So you divide the NPV by the present value under consideration. Present value of the variable under consideration. Present value of variable under consideration. So you need to find out the NPV of the project and you divide by present value of the variable under consideration. So we are talking about two variables, one is selling price, other one is variable cost, we'll look at the selling price first. NPV is 10,629 divided by variable under consideration selling price, so that gives you the sales present value 335,086. So this basically gives you the sensitivity of the sales price 3.17. You multiply 100, 3.17. So this gives you the sensitivity of selling price to the NPV. What do you mean by this? If the selling price drops more than 3.17, your project become non-viable. If you say that your selling price has to be reduced in order to meet the competition for various reasons, your selling price is reduced by 3.17 or more, not 3.17, more than 3.17, you will see that your project is not viable. In other words, your NPV will become negative NPV. So project is not accepted. So this is the sensitivity of our selling price, 3.17. The other side, you have to calculate the variable cost sensitivity. Again, the 10,629, that's your NPV, divided by variable under consideration, you can look at it in the suggested answer, 252,324. 252,324 into 100, present value of the variable is the variable cost, present value of variable cost, your 252,000. So when you compare, it's 4.21. So what is 4.21? Again, always remember that when you do sensitivity, it's always the assumption is that all other variables remain constant. Otherwise we can't get multiple changes at same time. So we assume always when you look at selling price, only selling price is changing, no other variable changes. When you look at variable cost, we assume that only variable cost is changing, no other variable changes. These are sensitivity analysis principle we always follow. So variable cost point of view, sensitivity is 4.21. Like earlier what I mentioned, selling price, variable cost, if it goes up, selling price we talked about reduction. Variable cost, if it goes up more than 4.21, that means your cost is going to go up. If it goes up more than 4.21, your project will be not viable. So your project will give you NPV, negative NPV. So if it is more than 4.21. So we should know that our variable cost needs to be controlled. Variable cost needs to be controlled within 4.21 increase over the project period. If you allow that to go up, then your project will be unviable. So please note, again, the sensitivity analysis when you look at, we take one variable at a time. So we assume that all other variables remain unchanged. But practically speaking, selling price can change, variable cost can change, fixed cost can change, everything can change in the market. So you need to be very careful. The project team have to sit together and look at it and see whether this 3.17 is something we can control throughout the project. 4.21 whether we can control over the project period. That means you need to make sure that your selling price is not reduced more than that percentage. Variable cost, we should not allow that to go up by this much. Only thing you need to remember, the percentage of what you got, the sensitivity. Is it a significant number or small number? You see that 3% selling price reduction, variable cost 4.21. In Sri Lankan context today with the inflation of 6%, right, we should know that the 4.2% increase is not something which is unreasonable. It can happen, right, even though they have also assumed 3% increase in variable cost, but this again I am talking about more than that. So if that is going to happen, then your project is unviable. So we have to be clearly knowing these are critical variables. These critical variables have to be controlled properly throughout the project. If we have doubt that whether we can manage this cost within the 5-year period, because revenue can sometimes come down, variable cost can go up. Both happens together. Then what happens? Project is unviable. But if you say the sensitivity is larger number, 15%, 20%, then we have very much cushion. Even if there is an increase, still we are in a very reasonable level because we can manage it. So please be aware that this example, this sensitivity has given us idea, it's very, very critical variables and you have to be very much sure that you can control this over the project period. If you can't, the project team has to sit together and decide no point in accepting this project because it's a risky project. Comparatively, it's a risky project because the percentage of sensitivity is small, very small. And especially like country like us, these kind of changes are always possible. So you want to be very careful when you are accepting the project, this kind of situation. We now look at question number 2 of July 2021, question number 2. If you read the question, it's about ABC Private Limited, a company specializes in herbal products and Ayurvedic medicine, and they are exporting the products to Europe, and they appoint or they engage an exporter in Sri Lanka called PQR, who will be facilitating the sales to Europe. So what you do, you as a Sri Lankan local company, you sell the goods to the local company. Local company is exporting to Europe. So actually you are not selling as such, you are basically passing on to them and they send the goods to Europe. For that purpose, the local company, which is called PQR, charges you a commission on the sale proceeds what they get. So that's basically given in the question. When you read further, over the COVID period, the PQR company has said, I want 9% commission for doing this transaction. So they, the local company PQR, invoices the customer in Europe and they collect the money from the Europe. But to Sri Lankan company, that is the ABC company, the PQR will make the payment within 30 days. So we, Sri Lankan company ABC, gets the money within 30 days if we give it to the PQR. But PQR send the goods to Europe and collect the money within 6 months. So therefore they charge us a commission of 9%. Since commission rate has been increased from 5 to 9% during the COVID period. ABC is now realizing they are spending more money to the commission. So then they are looking at the option of sending goods directly to Europe rather than through ABC or so PQR. Without you sending through PQR, you are trying to send the goods to customer in another country directly. So what they are saying, they have got an order from France, they got order for 320 million. So what they are expecting is to goods to be delivered immediately and invoice immediately. But the payment will be made in 6 months time. And they have given you the 320 million will be invoiced, rupee value of 320 million will be invoiced today with Euro Lankan rupee exchange rate. So Euro and Lankan rupee exchange rate what you have today, based on that you have to invoice them. So your invoice value will be 320 million divided by your exchange rate, divided by exchange rate. Then they say that due to the certain restriction in the country, the company CFO is concerned whether Sri Lanka rupee will appreciate, because generally if the Sri Lanka rupee depreciate against the foreign currency, as an exporter you are benefited. All of us have to understand that if Sri Lankan company is exporting goods to a foreign country and the monies are going to come in foreign currency, Sri Lanka rupee depreciation is a good thing for the exporter. But importer point of view, if the Sri Lanka rupee is depreciating, he is going to lose money. Why? He has to pay more money to the supplier. So here the example is about exporter company. So we have a benefit of depreciation. But actually the problem that they are talking about, not the depreciation of rupee, appreciation. So according to question, the CFO is concerned whether the Lankan rupee will appreciate against the euro over the next 6 months due to the current forex restriction. So he is concerned whether the Sri Lankan rupee will appreciate against euro. When it appreciates, we will lose money in terms of sale proceeds receiving. So they are concerned. So he has thought, okay, better thing to do forward exchange contract. So forward exchange contract rates are given. Only thing they have not given the forward exchange contract rate between euro currency and Sri Lankan rupees. They have given you the US dollar and euro and US dollar and Sri Lankan rupee. So there is a US dollar being the common currency. So we need to know that when you are given a common currency and then given two rates, you can always calculate the cross exchange rate between Sri Lankan rupee and euro currency. So that we will come to that. So today's spot rate, 1 euro equals to 231 rupees. Today's spot rate is 1 euro equals to 231 rupees. And they have given you further information about deposit and borrowing rate in France and Sri Lanka, or maybe the euro currency deposits and Sri Lankan currency deposit rates are given for 1 year, and borrowing rates are also given for same euro currency and Sri Lankan currency. So when we look at these two rates given for two countries, I am sure like all of you all with the foreign currency management knowledge, you will have to think what could be the question first. So it has to be forward exchange risk management contract or maybe risk management area. One of the thing is money market hedging. So when you look at the question now, advise ABC on the best course of action it would take in respect to a new order it has received. So actually the question, 12 marks question, advise ABC, the company, local company, on the best course of action it would take in respect to a new order it has received. So they are simply asking regarding the new order. So new order rupee value is 320 million and spot rate means today exchange rate, 1 euro currency equals to rupees 231. So 1 euro equals to 231 rupees. So we should know that you are going to export to France 320 million worth of goods, rupee value. What is the order or the invoice value? Invoice value in euro equals to 320 million divided by 231. That gives you the euro currency, how much the invoice value. So we can calculate that. So that basically knows that this is our value of the euro currency we are going to get as sale proceeds in 6 months time. Now the question is asking, advise ABC on the best course of action it could take in respect to new order it has received. So we know this is the transaction, 320 million. So we know that the 320 million today's value or the today's exchange rate, the 320 million is worth how much the $1,385,000 to 81. This is the euro currency we have to receive. We have to receive 1,385,000 to 81. This is the amount of money we have to receive in 6 months' time for the exports that you have done. Now what is the question? What is the best course of action? So we understand the CFO of the company is concerned about the exchange rate appreciation or Sri Lanka rupee appreciation against euro currency. So he has to now do some risk management in order to reduce the impact of exchange rate risk. So it's about foreign currency risk management area. So we have a risk, exchange rate risk. We need to manage that. So what are the alternatives we have got? So one of the alternative is getting into forward exchange contract. They have given you the information about forward exchange contract. We will come to that. So we have to find out if we get into forward exchange contract, what is the rupee proceeds finally we get to from the export on the forward exchange contract front. Second, we can use money market hedging technique. And we can find out how much is the proceeds we can get in 6 months' time. So those are two techniques I would say that you can use. Two techniques you can use to find out what is the best course of action. But there is another side of it. Actually, it's not very clear based on the question whether you can, for this order what you have got, for the order you have got from the France, whether you can ask your local PQR to do the transaction like in the past. Right? It's not given clearly. But if you can give it back to your local company PQR to handle these exports, then what is the value of proceeds you get? You can look at that. But my understanding of the question is that you have two approaches. One is forward exchange contract or money market hedging. The giving to the local party, actually that is what the concern you had. You had the concern because the 9% commission is too much for you. That is why you wanted to shift it to direct exports to Europe. So you have found a customer and you can invoice now. Only thing is you are concerned about the exchange rate. So in order to reduce the impact of exchange rate risk, you have to decide what are the techniques I have got. So in this question there are two techniques we are talking about, forward exchange contract and money market hedging. So we look at those two techniques. Right, even though the suggested answer talks about the giving to the local company, right, I will discuss that third, because that's something I would say like it's not very clearly given whether you can give it to the party because you are deciding to go to direct exports. So if you want you can think. So we will calculate that numbers also, but properly speaking the best course of action for the company has got is forward exchange contract and money market hedging to reduce the exchange rate impact. Okay, after you deciding to shift from the local company PQR to the direct export, you don't really look at that option also. But if you want, you can look at it. The examiner has given or the suggested answer given that option also. We will come to that. Let's look at the first forward exchange contract. So they have given you the $1 equals to 195 rupees. $1 equals to 195 rupees and 1 euro equals to $1.1. These are the 6-month forward rate. Please understand. These are 6-month 6-month forward rate. $1 equals 195, 1 euro equals 1.12. Now what is the currency we are talking about? Euro currency. So euro currency to Sri Lankan rupee. So $1 is 195 rupees in 6 months time forward exchange contract. 1 euro equals $1.1, $2. So 1 euro equals to how many rupees? How many rupees? So how do you calculate 195 into 1.12. 195 into 1.12 equals to 218.4. 218.4 is your 6 month forward. 6 month forward between 1 euro equals to rupees. This is a 6 month forward rate, 218.4. So if you look at it, if it is 218.4, if you are going to get 1,385,281 euros, and this is a 6 month forward rate, 218.4, what is the rupee value you are going to get in 6 months? So the suggested answer, you can look at it, 6 months time you are going to get 302 million. So 6 months time, rupee proceeds, you get 302 million. 302 million. 302 million. Now today's spot rate is 231. Today's spot rate is 231 between Sri Lankan rupee and euro. 6 month forward in the banking cycle, 218.4. 218.4. That means 231 rupee per euro becoming 218.4, which means Sri Lanka rupee depreciating or appreciating. The answer is appreciating. You pay lesser rupees to buy 1 euro currency. So Sri Lanka rupee is appreciating. Sri Lanka rupee is appreciating. So this is the concern the finance manager or CFO had. So 218.4 is the amount of money you have to pay to buy 1 euro currency. So in that way, when you get into forward exchange contract, 6 months time, you get 1.3 million euro currency from the customer in France, 6 months time. You go and sell that foreign currency to the banking circle at the rate of 218.4 and you get 302 million. So this is the forward exchange contract, the money you are going to get by selling the foreign currency to the bank. Then we move on to the second technique. Second technique is basically money market hedging. So we need to understand what do you mean by money market hedging. We use the money market instruments, which are short-term deposit and short-term borrowing. We can use the money market hedging, money market instruments, short-term borrowing or short-term deposit instrument to manage the exchange rate risk. Here we are not talking about anything else, we are managing the exchange rate risk by using money market instruments. Short-term deposit, short-term borrowing. So we are talking about 6 month period in this whole thing. So we have to understand within 6 months or not within 6 months, 6 months time we are going to get 6 months time the company is going to receive, there is a receivable of 1,385,281 euro currency. 6 month time we have a receivable 1,385,281. So when we use the money market technique, what we need to do, since we have an asset, receivable is asset, we have to create a liability for the same amount. In 6 months time we should have a liability for 1,385,281. So we have to understand, in order to reduce the exchange rate impact, since we have euro currency receivable in 6 months time, you need to create liability for 6 months time for the same amount. So that means you have to borrow today less than 1.3 million euros, so that 6 months time the borrowing will be 1,385,000. So how much is that borrowing? So you can look at it, 1,385,000 divided by your borrowing rate 1.015. So that gives you have to borrow today 1,385,000 364, 809. So you borrow today 1,364,809 at the rate of, they have given you the France borrowing rate 3%. So you can borrow the euros today at 3% per annum, but we are talking about 6-month period, so that's why 1.5 I have taken. So with the interest, the amount has to be 1,385,000, which is the liability you will have to set off the asset what you are going to get in 6 months time. So we will have to create a liability today which will be in 6 months time to set off against the asset what you are going to get from the customer. So 1,364,000 today you will borrow. You will borrow the euro currency 1,364,000 at the rate of 1.5% for 6-month period. Once you get that money, that is your first step. Second, convert the euro currency. Convert 1,364,809 to Sri Lankan rupees today. Today rate is 231. Today rate is 231. So how much you get? 315 million. 315 million. You convert your borrowed money euro to Sri Lankan rupee at today's spot rate 231. So you are converting your foreign currency to rupee today, that gives you 350 million. Third, what you do? Deposit. Deposit rupees 315 million for 6 months. 6 months. That will give you 315 million. You will deposit for 6 months at the rate of 6% per annum. That means 3% per 6 months. So on that basis, you will get a capital and interest together 324 million. 324 million. So that's basically the amount of proceeds you get it in 6 months time. So 6 months time what you have? You have a receivable from the customer for this much, 1,385,000, and you have a liability which you have borrowed in Sri Lanka, which will have a liability of 1,385,000 in the 6 months time. So you have an asset, you have a liability. So what you do 6 months time, you will take the export proceeds, set off with your liability. 1 to 1 you set off. But you have a rupee deposit. From the converted money, you have your money deposited in Sri Lankan rupee for 6 months. That gives you 324 million. So finally, your net proceeds of this money market hedging 324 million. 324 million. So what we have to understand that the forward exchange contract we got 302 million. You can look at it in the answer. 302 million forward exchange contract has given us the net proceeds, and money market hedging has given us 324 million. So these two options shows what is the best course of action. Whether we go with the forward exchange contract, whether we go with the money market hedging. So money market hedging is giving more net proceeds from the customer than the forward exchange contract. So basically the answer is money market hedging. But as I mentioned, the suggested answer given another option also they have compared, which may not be relevant because that's not very clearly mentioned about that you have option of giving back to them. But for understanding purposes, you can calculate that. You can look at it. Sales value 320 million and the commission 9% you have to pay, 28.8 million. Then net proceeds you receive in 1 month. Because even though the customer in Europe is taking 6 months to pay, when you sell to Sri Lankan company, you are going to get the money in 1 month's time. So 1 month time you get 291.2 million after the commission, which you can interest. You can deposit that money for 5 months because your comparison is with 6 months story. 5 months you can invest at the deposit rate of Sri Lankan rupee 6% per annum. Then you get 298.48. So when you look at it, 302 million is in forward exchange contract, 324 million is in money market hedging, and this option which is anyway with your present customer or present company in Sri Lanka PQR, your amount of money you get net proceeds 298 million. So I think that anyway the money market hedging is the best option you have got, but if you want to look at the Sri Lankan option also, you can say 298 million you are going to get. So this is basically the question about forward exchange contract and money market hedging in order to minimize your exchange rate risk. So 298 million in the local context, forward exchange contract 302 million and 324 million in the money market hedging. So money market hedging is the best approach you could consider to manage your exchange rate risk. Okay. So that's your A part of the question. Then the B part. Can you move on to B part? It's about a company or a bank, Sri Lanka Regional Commercial Bank has decided to go for 1 billion debenture issue, 1 billion debenture issue. Each debenture unit priced at 100 rupees. Each debenture unit priced at 100 rupees. So 1 billion is the total value. So you can find out how many debentures involved here to improve the capital adequacy ratio and the banking requirements. And they have partnered a company called Alliance Investment Bank, AIB, for this issue. Debenture provides return of 9.5% per annum, payable semi-annually. So it's a return of annual 9.5, but payable, interest payable semi-annually, every 6 months. And there are 3-year period. It's not 5-year debenture. Generally you get 5-year debentures, but here 3-year debentures. Say SLRCB, that is the company we are talking, redeem the debenture at par value. So end of the 3-year, they will redeeming at par value. Then AIB, that's the local party we are given or partnered for this issue, debenture issue, like a manager. They charge you 0.75% of debenture value as the placement fees. And the legal consultant charges you 0.2% of the debenture value as upfront legal fees. So you have a consultant fee or a placement fee and the legal fee. Following additional information given, they are talking about there will be a trustee involvement in this debenture issue, where you have to pay 300,000 upfront, and there is a 5% inflationary impact on this amount payable at the end of each year over the 3-year debenture period. So you need to understand that there is a trustee fee, 300,000 at the beginning, and every year you have to pay 5% more. Marketing expenditure, road shows, printing, all that on the prospectus, 5 million you have to incur, that is anyway you have to incur now. Regulatory fees charged by the authority, 75,000 upfront and 100,000 per annum, which is payable at the end of each year until the tenure of the debenture. So the rating agency, for their fees 3 million given. So you can understand, it's about a debenture issue, a simple debenture company is issuing, and then they will redeeming in 3 years time, redeeming in 3 years time, and 9.5% is annual rate, but they are going to pay semi-annually. But there are certain costs they are incurring to go for a debenture issue. Those costs are given here up to now what I discussed. Question 1 or Roman number 1. Determine the net proceeds. Net proceeds raised by the company in year 0 from the debenture issue and the cost of the issue as a percentage of debenture value. 3 marks. So simply the examiner wants how much is the amount of money you are going to raise from the debenture on the year 0 or now. Net proceeds. Even though it looks like 1 billion debenture, if there is no cost involved, you get 1 billion to earn. But we have been given a list of costs. So they are asking what is the net proceeds you get from the debenture issue. So we have to reduce all the costs they have mentioned now, not the future costs, today costs. You reduce all the costs and find out what is the net proceeds. At the same time, they want you to calculate the percentage of the cost of your debenture value what you have generated. So that's a percentage they are asking. So can you move on to the suggested answer? So you can see the 1 billion debenture value, it's nicely given, 1 billion debenture value, and unit price, that is per debenture 100 rupees, that means 10 million debentures we are going to issue. 10 million debentures and 100 rupees is going to give us 1 billion rupees. Alliance investment, the management manager fee 0.75, so that is 7.5 million. Out of 1 billion, 0.75% you have to pay as a fees, that you have to pay now immediately. The legal fees, it's 0.2%, there is 2 million rupees of your total debenture value. Trustees fee, there are 2 components. Upfront you have to pay a trustees fee, that is 300,000, and there is a inflationary impacted trustee fee every year. But we are talking about year 0, how much net proceeds you are going to get. So therefore we don't take the future cost, we take only the trustee fee. Today what you have to pay, 300,000. Marketing fee and the road shows and stuff, 5 million, which you reduce. Regulatory fee, again there are two components, what you pay today upfront and the annual payment. Annual payment we don't consider here because we are talking about year 0 net proceeds, how much we are going to get. So only the regulatory fee what you have to pay now, 750,000. Rating agency, obviously you have to pay now 3 million rupees. So how much net proceeds you are going to get? From 1 billion, all the cost you reduce, 981.45 million. 981.45 million. So once you get that, that's your net proceeds you are going to get. Cost of the issue, all the cost what you have deducted, 18.5 million. So what is the percentage of cost you have incurred in raising the 1 billion money? To raise the 1 billion money, apart from the interest cost, you have a cost you are incurring. This is the issue cost. Issue cost 1.86%. That's your 3 marks question. Okay, very easy questions. These are. Second, Roman number 2. Calculate the cash flows of the debenture and determine the yield to maturity of this debenture issue. Always remember, any financial instrument, if they want you to find out the yield or the return or the cost of the debenture, you need to understand, you have to calculate IRR. Any instrument, if they ask you to calculate cost or the yield or the return of the instrument, you need to calculate IRR of the instrument. When you calculate IRR, that basically reflects that return or cost of the instrument. In this case, it's a company, we are talking about the bank. The company is going for a debenture issue. They want you to find out what is the cost of this debenture. Cost in the sense, not the issue cost, the what do you call, yield of the instrument. Yield is the real cost you are going to incur for the debenture of 3-year period. Annually, what is your average yield? So that's basically the question, 8 marks. So the examiner is very, very clear here. Calculate the cash flows of the debenture. Because if you just ask a yield to maturity itself, it's enough. You should know what has to be done. But the examiner given you a further hint, calculate the cash flow. So you need to know always to calculate IRR, you need the cash flows. So the cash flows are given here. What we looked at earlier, same thing, only thing now you are putting into a cash flow statement. You can see that it's about six periods. Why? 3 years is the number of years. But the annual interest of 9.5% you are going to pay every 6 months. So we need to break that into 6 months interval. So you can see the 6 periods involved. Some people take the annual period as year only 1 to 3 years, 3 years. So you will get the yield. There is no wrong in that. Only thing is that slight impact is there because your cash flow is going out every 6 months. So it's better that we calculate the periodic thing. So better you divide the year into 2. That means 6 periods you will have for the 3-year period. So 1 billion debenture, and you will see that the cost whatever we talked about for year 0 is listed out in year 0. And addition, the trustee fee and the regulatory fee, as I mentioned, you have to pay with the inflationary impact every year. Trustee fee is of course with the inflation impact of 5%. You can see in the year 1, 2, 3 that 5% impacted cost is there. Regulatory fee, of course, no inflation impact they are given. It's 100,000 per annum, you have to pay for 3 years. It's given there. So you get your interest cost 9.5. Since your 9.5% is annual cost, you have to divide into 2. Semi-annually you have to pay. That is 47.5 million. 47.5 million every 6 months you have to pay to the customer. So when you look at your cash flows, year 0 you get cash flow, that is 1 billion you receive, and you incur certain costs. Those are issue costs what we talked earlier. All you have 0 pay. Then you have 6 months, every 6 months you pay the interest to the customer and or the investors. In addition you have the regulatory fees and the trustee fees. So when you look at all your cost, all the cash flows, you can see that 981 million to 1 billion, because redemption is happening at the end of the 5th year or 3rd year. 1 billion is given, and they have given you the they have taken 2 rates, because in order to calculate IRR you need to take always 2 rates. So you can decide any 2 rates. Only thing as a principle, please make sure that the rates you take to calculate IRR, make sure that it's not having a significant difference. Because when you have a significant difference, your true IRR may not be arrived. Even though we are using a formula to calculate IRR, the IRR will be always reasonable to the true IRR only if you use a reasonable gap between two rates. If you take 10% and 20%, the gap is larger, then your true IRR and the calculated IRR using formula will not be close. Ideally, true IRR you can calculate it by the graphical format. But exam point of view, you are not going to be asked on that. So we need to know the formula, but the formula application is fine provided you get the two IRR calculated NPV rates what you are taking has to be reasonably close. Don't take a larger gap between the two rates. So here they have taken 9%. You can see the 9%, that is 1 year rate. So the 6 months cash flows, so it's 4.5. On that basis, your NPV is 32.5 million. Then you take another rate, 11%. So you have taken 9 and 11 for annual rate. So that is 4.5 and 5.5. So you get 17.8 million NPV. So there are two cash flows, NPVs are calculated. Then they calculate your IRR. So the IRR is coming to 10.29. So yield of the instrument or the cost of the debenture, yield of the instrument or cost of the debenture is only 10.29. Even though you see the 9.5 is the cost, even though it looks like 9.5 is the cost based on the interest, the real cost for the company is roughly 10.29. Why? There are other additional costs you are incurring in issuing the debenture to the customer. Okay. So 10.29 is your IRR or yield of the instrument. Roman number 3, they say that Simon Seniviratna invested 5 million in the debenture, rupees 5 million he has invested in the debenture. Debenture interest income is liable to tax at the rate of 12%. So now this is not from the company point of view, this is from the investor point of view. First two parts we talked about from the company point of view, the bank who has issued the debenture. What is the cost to the company, what is the IRR of the debenture, all that is from company point of view. The third part is they are talking from investor point of view. Investor is Simon Seniviratna who has invested 5 million and then the interest income he gets is liable for tax at 12%. His wife has invested 5 million in the fixed deposit. So she has not invested in debenture, she has invested in the fixed deposit. Same bank, yielding an interest of 7.5%, and the tax will be 5% on withholding tax, as for withholding tax. Determine whose investment has yielded higher return after tax at the end of year 1 and reason for such a difference. Only 2 marks. So it's a very simple question. They said that there are two people, right, husband and wife. Husband invests the 5 million in the debenture, wife invests the 5 million in the fixed deposit. Same bank. Husband's tax rate or the withholding tax is 12%, wife's tax is 5%. So they are asking you what is the net interest income both of them gets. From the debenture how much they get, how much fixed deposit they get. So you can see the suggested answer, the comparison is given in the table. You can see that Simon debenture 5 million and his wife's deposit 5 million, interest rate 9.5 and 7.5. Accordingly, the interest income is given 475,000, 375,000. Tax rate, two investment opportunities are two different rates, 12% and 5%. So net amount, net of tax, the investor gets, both investor gets 418,000 and 356,000. So difference between the interest income of both 61,750. Very simple question. 61,000 is more. The question is asking, one is you calculate the number, second reason for such a difference. Why the husband is getting more interest income net of tax than the wife, even though it's the same institution, same amount of deposit or investment, still the net amount is more for husband than wife. Why? The reason being debenture and the bank deposit, same bank. The bank deposits comparatively is more safer than the debenture, because the debenture here they never talked about a debenture is secured debenture, so it's unsecured debenture. So debenture is comparatively a riskier investment to the bank deposit. Same bank. because you know that in Sri Lanka that there is insurance scheme by the regulator central bank for the deposits between the bank and the finance company. So if there is a collapse of the bank or finance company, there is a safety for the customer to get some money by the insurance scheme given by the central bank. So you need to understand that therefore comparatively deposits holders are safer than a debenture investor. So debenture investor will get priority after the deposit holder. So even if there is a crisis in the bank, they will have to pay the deposit holder first before the debenture holder. Unless the debentures are secured debentures. If the debenture what they have issued as a secured debenture, then there is an asset which is mortgage part of the issue. So the investor who invests money in debenture are safeguarded. Even if the company collapses, they can get their money from the asset which was mortgage. But in this case, they are not talking about asset mortgage or no security. So therefore, we should know that normally deposit and debenture, when you compare, deposit is riskier than the deposits, because deposits are more safer than debenture. But return point of view, debenture, since the risk is higher, you get better return than a deposit. So we all have to understand that debentures have more return than the deposits. That's what you are seeing, that 9.5% debenture, 7.5% deposits. Why that return is higher? Always we need to understand the basic principle. Return and risk are on the same line. More the risk, more the return you expect. Lower the risk, lower the return. So deposits are lower comparatively in risk point of view. Therefore, return expectation or return provided also lower than the debenture investment. So that's basically the answer.